Imagine if I told you that every major stock market crash in history eventually made long-term investors richer. In 2008, people panicked. In 2020, the world shut down. In 2022, headlines screamed recession and collapse. Fear was everywhere. But the people who understood how the stock market actually works didn't run. They stayed. And over time, they multiplied their wealth. So in the next few minutes, I'm going to break down the stock market for beginners using a logical framework that removes emotion and replaces it with strategy. And make sure you stay until the end, because there's one rule beginners ignore that quietly costs them thousands of dollars. First, let's simplify what the stock market really is. It's not a casino. It's not a get-rich-quick machine. It's a capital allocation system. When you buy a stock, you are buying a small piece of a real company. That could be Apple, Amazon, Tesla, or any other publicly traded business. When those companies grow, expand, increase profits, and dominate markets, your ownership becomes more valuable. That's the core logic. You're not betting on price movement. You're investing in business growth. Over time, strong businesses tend to increase in value because they generate revenue, innovate, and scale. Now here's where most beginners go wrong. They enter the market emotionally. They see green charts, hear stories of someone doubling their money, and jump in expecting instant gains. But the market doesn't move in straight lines. It moves in cycles. When prices drop 10% or 20%, fear kicks in. News headlines amplify panic, and beginners sell at a loss. The market didn't defeat them, their emotions did. Historically, markets have always recovered from downturns, but only patient investors benefit from that recovery. Let's introduce what I call the billion-dollar logic framework. Rule number 1, the stock market rewards ownership, not speculation. In the short term, prices are unpredictable. In the long term, markets trend upward because businesses grow and economies expand. The S&P 500, which represents around 500 of the largest companies in the United States, has averaged roughly 10% per year over long periods. That doesn't mean every year is positive, but over decades, time smooths out volatility. Time is the investor's greatest asset. Now let's talk about compounding, because this is where things get powerful. Imagine investing just $250 per month consistently, not trying to time the market, not chasing trends, just steady investing at an average 10% annual return. Over 30 years, that doesn't turn into a few $1,000s. It can grow into hundreds of thousands. Over 35 or 40 years, it can cross the $1 million mark. That's not hype, it's mathematics. Compounding works like a snowball rolling downhill. At first, progress seems slow, but as gains start earning growth accelerates dramatically. Most beginners underestimate this because they focus on short-term results instead of long-term acceleration. Now here's another beginner-friendly concept: index funds. Many people think you need to pick the next big stock to succeed. In reality, one of the simplest strategies is investing in an index fund. An index fund allows you to invest in hundreds of companies at once. For example, instead of choosing between Apple or Microsoft, you can own both, plus hundreds more, in a single investment. If one company struggles, others balance it out. This reduces risk and creates diversification automatically. It's like owning the entire leaderboard instead of betting on one player. And here's the rule I mentioned at the beginning, the one that costs beginners thousands. Consistency beats timing. Most people wait for the perfect moment to invest. They try to predict crashes, tops, and bottoms. But historically, the investors who succeed aren't the ones who time perfectly. They're the ones who stay invested consistently over time. Time in the market beats timing the market. The longer your money is working, the greater the probability of growth. So if you're a beginner, the logical path isn't complicated. Build an emergency fund first. Invest consistently, focus on long-term ownership. Use index funds for diversification. And most importantly, remove emotion from the process. The stock market isn't about gambling. It's about discipline, patience, and understanding how capital grows over time. Once you understand the logic behind it, fear becomes noise, and strategy becomes power. This is just the foundation. In the next part, we'll break down exactly how to start investing step by step, from choosing an account to selecting your first index fund, using a simple system anyone can follow. Because understanding the stock market is one thing, using it intelligently is another. Welcome to Billion-Dollar Logic, where we think like investors, not gamblers. So now you understand that the stock market is not gambling, it's ownership. But here's the real question beginners never ask. If companies grow over time, why do most people still lose money in the market? The answer is not strategy, it's psychology. The stock market is designed to transfer money from the impatient to the patient. When prices drop, beginners panic and sell. When prices rise fast, beginners chase and buy at the top. And this emotional cycle is exactly how smart investors quietly build wealth while everyone else reacts emotionally. If you master this one principle, you're already ahead of 80% of beginners. Now let's talk about how money actually grows inside the market. There are only 3 real ways you make money from stocks. First, the company grows, and the stock price increases over time. Second, some companies pay you dividends, which means they literally share profits with you just for holding their stock. And third, compound growth. This is where things become powerful. When your investment grows, and then that growth starts generating its own growth, wealth begins accelerating. This is how small amounts turn into massive portfolios over 10 to 20 years. Not overnight, not in a week, but through consistency. Here's where most beginners make their biggest mistake. They try to pick the next big stock. They look for the next Amazon, the next Tesla, the next explosive company. But what professional investors often do instead is something much simpler. They invest in the entire market using index funds or ETFs. Instead of betting on one company, they buy a small piece of hundreds of companies at once. This reduces risk dramatically. You're not trying to be a genius. You're trying to be consistent. And now, let me give you a simple 3-step framework beginners can follow safely. Step 1. Open a brokerage account with a regulated platform. Step 2. Start with an index fund that tracks the overall market like the S&P 500. Step 3. Invest consistently every month, no matter what the market is doing. When it drops, you buy. When it rises, you still buy. Over time, this strategy removes emotion from the equation and lets time do the heavy lifting. But here's something nobody tells beginners. The stock market is not a get-rich-quick system. It is a get-rich-patient system. If you expect fast results, you'll quit. If you understand the long-term logic, you'll stay. And staying is where wealth is built. Now imagine this. If someone started investing just $200 a month in a diversified index fund and averaged historical market returns, in 20 years they could potentially build a 6-figure portfolio. Not by trading daily, not by watching charts every hour, but by staying consistent. That's the billion-dollar logic. Boring decisions that create extraordinary results. In the next video, we'll break down exactly how to analyze a stock before buying it, even if you have zero financial background. Because once you understand how to read a company, you stop guessing and start investing with confidence.